Hello, everyone. Today, our guest is Ron Diamond, the founder and chairman of Diamond Wealth, a keynote speaker at dozens of family office conferences around the world. How are you today, Ron?
I'm terrific. Thank you for having me.
Thank you so much, Ron, for joining. Our today's topic is how and why family offices are disrupting the private equity and venture capital industries. And the first question for you, Ron, is on the current state of the private market investment infrastructure. Frankly, it is very fragmented. Private businesses in the United States produce over 50% of gross domestic product. But unlike the publicly traded companies, the private businesses do not have straightforward access to capital. We know that venture firms, as well as friends and family, support early stage startups. The private equity companies normally come at the later stage and supply capital to later stage companies. Lately, we have seen emergence of crowdfunding platforms and the new sources of capital like registered investment advisors that we have just spoken about. Also, there are banks, there are other lenders, plenty of different institutions are in that space. Assumingly, the family offices won't be able to replace the entire infrastructure, but will they be able to effectively integrate into it?
The answer is yes. So just as a backdrop, there's currently about $10 trillion in capital in family offices. And just to compare that, there's roughly $4.5 trillion in capital worldwide in hedge funds. You combine that with the fact that you've got $65 trillion in capital that's moving downstream from the baby boomers to the next gen in the next 15 years, which will be the largest transfer of wealth ever. This market, the family office market, will be larger than the private equity and venture capital markets combined. So the market itself is massive. Now, the issue right now is we're still maybe in the third inning. It's still very early. In general, family offices are inefficient, fragmented, and silos. Some of them are very institutionalized, but that's maybe 3 to 5% of them. Most of them are not. The other problem is that the model itself today doesn't work. I mean, family offices, only 25% of family offices make it to the second generation, 10 make it to the third, and 5 make it to the fourth. You combine that with the fact that 68% of family offices started since 2000. Half of those have started since the crash of '08. So this is a brand new industry, and it's not really working well. So why am I so optimistic about this industry? I'm optimistic because I believe that as private equity and venture capital disrupted the public markets in the early 80s, family offices will disrupt private equity and venture capital. They'll never replace them because they're massive markets, but they're going to disrupt them. And the reason has to do with alignment of interest. So my background, I used to run a hedge fund. So if you're running a company and you've got to report to a guy like me or an analyst every 90 days, it's very difficult to really run your company. You're basically managing earnings. So the reason private equity and venture capital exploded in the 80s was because it was a better model. 2% covers the overhead, 20%, I only make money if you make money. And you don't have to report every 90 days. So you can grow long term, and you don't have to be myopic and just manage earnings. The problem with the venture capital and private equity industries in general, and I'm generalizing, they've bastardized the business and it's become an AUM game. And as a result of that, these funds are just too big, and they realize that they can make money on the 2%. So if you've got a $500 million fund and they have the ability to raise $5 billion, in many instances, and again, I'm generalizing, they're going to opt for the larger one. So I'll give you one specific example, which to me is a microcosm of what's wrong with the industry and why family offices are going to start to disrupt private equity and venture capital. The one thing family offices have is something called patient capital. They don't have to turn money over every 3 to 5 years. Venture capital firms and private equity firms, based on the compensation structure for the partners, that they do. So I had a friend who did a roll-up of logistics companies in New York, and he needed $150 million. And the placement agent was able to get him $500 million based on he had an incredible track record. Placement agent, my friend said, terrific, I just need $150 million and let's get started. Placement agent literally came over to his house and wrote down 2% of 500 million equals X, 2% of 150 million equals Y, what am I missing? And my friend, who was a bit incredulous, said, what you're missing is if I do what you want me to do, there won't be a fund two. Because yes, I'm smart enough to know that 2% of $500 million is I'll make more money today and maybe in the next couple of years, but I can't deploy the other 350. Again, that's just a microcosm of, in my opinion, what's wrong with the industry. And what's happening is as family offices become more efficient, less siloed and less fragmented, you're going to start to see them, families like the Pritzkers, the Dells, the Bloombergs, they've institutionalized. They can compete directly with the Carlyles, the Blackstones of the world, but they're actually having an advantage because they don't have to turn money over every 3 to 5 years. So the last final point I'll make and why I think family offices are going to disrupt private equity and venture capital, if you look at companies, typically private equity firm A buys a company, holds it for 3 to 5 years, sells it to private equity firm B or a strategic. But typically it's private equity to private equity, sells it again to another private equity. Over the course of 20 years, that company's probably been bought and sold 4 times, maybe 5 times. If you look at the taxes and the transaction costs that are involved in that versus a family office who buys a company from day one and just holds that company for 20 years and doesn't have the taxes, doesn't have to replace the money, doesn't have the transaction costs, there's a huge difference. So more and more people are going to be looking to partner with family offices. The problem right now is that the rich people can't find the smart people and the smart people can't find the rich people. That's starting to change. And as that changes, more and more people are going to want to work with family offices. And I think it's going to be a massive change.
Thank you so much for your thorough response, Ron. Can the broader investor base be incorporated into family office investment ecosystem? For example, accredited individual investors, if they want to invest along with family offices, will there be an opportunity for that?
The answer is yes. So we're still early in this. So basically what happened, Michael Dell's family office, which is, we've done some work with, it's one of the most sophisticated family offices in the country. I mean, it's massive. It's over $20 billion. They just merged with BDT, which is Byron Scott, which is a merchant bank in Chicago. And that was pretty big. And I think what's going to happen, I had a David Rubenstein from Carlyle Group on a podcast. I was speaking to him 2 days ago, and I asked him actually this very question. And in his opinion, and I agree with it, that what's going to happen is right now, the firms like Carlyle and Blackstone and KKR, everybody's heard of them. Most people haven't heard of the family offices per se, unless it's a name like Michael Dell or Michael Bloomberg. What's going to happen is I could see, and this is what David Rubenstein said as well, I could see in 5 to 10 years that these family offices are as big and as well known as the KKRs and the Blackstones of the world. The difference being the preponderance of the money is going to be coming from the actual family office, and most of the investors. And again, most people, individuals, they want to work with family offices because family offices, again, if you look at it, at least in my opinion, in order to create alpha, you need to be able to operate. Most of these family offices, they made their money doing something. They operated in some capacity. If you look at the private equity and venture capital firms, and again, I'm generalizing, and I like venture capital and private equity firms, and I've got money invested in them. But in general, if you look at them, most of them are finance guys. So what happens is it's not complicated. I could financially engineer many companies and make a profit short term. And that's what a lot of the private equity firms do. It's more financial engineering. But in order to create true alpha, in my opinion, you have to be able to operate. And that's where family offices are going to make a huge difference. So the answer to your question is yes. I think you're going to see more and more people being able to invest alongside family offices and family offices wanting to take an outside capital, because at the end of the day, no matter how much money you have, you still need more money. I mean, even the Pritzkers are out, as wealthy as they are, they're out raising money. So these family offices are going to compete and going to become known entities such as the Morgan Stanleys and the Goldman Sachs. It's way down the road, but you're going to see much more brand recognition and brand identity over the next 5 to 10 years.
Perfect. You have preceded a couple of questions that are following up. Maybe we'll just elaborate a little in deeper, go deeper in certain aspects. But at this point, the question I want to ask: availability of capital and quick decision making process may cause a little bit of a monopoly game in a sense. For example, there have been strategies at some family offices to buy rare metals mines to control 30 to 40% of certain, supply chains. What is the antidote for that?
The answer is yes, but again, there's also human nature, right? So when you say the word family office, you're painting everybody with a broad brush. So family offices are different. I mean, there's roughly 17,000 family offices in the world. And they're all different. And the other thing is everybody has a different objective, right? So some family offices, their objective is just wealth preservation. They're worth $1 billion. That's more money they're going to ever need, or their kids or grandkids. They're just looking to preserve the capital. And then you've got some family offices that are uber aggressive and want to just double or triple the amount of net worth from $1 billion to $2 or $3 billion. So, it's a broad brush when you talk about family offices in general. You're also going to see, to your point, family offices it's not a panacea. I mean, and there will be some bad actors as family offices, but in general, it's going to be a lot less. Because if you think about it, the family office, what they have is their reputation and their name. And I think it's going to be much more challenging for a family office to not do what's in the best interest of the society in general. To give you an example, about a third of the family offices currently invest in what's called impact investing. I'm 58. I never looked at the back of a soda can to see where it was made. It's not that I was a bad guy. I just didn't have this thing called the internet, right? So I had an Encyclopedia Britannica. My kids now, when they buy a pair of jeans or buy, a sweater, they want to know who makes it, how do they make it, how do they treat their employees, and they've got access to that individual right away, instantly. So as a result of that, family offices right now, roughly a third invest in impact investing. That's going to probably go up to about 50%, and it's driven primarily by the millennials. It's not driven by the older generation going down. It's from the younger generation going up. And I think one of the biggest advantages that family offices have, and where my North Star is, and maybe we touch on this later, is if you look at what Michael Milken did for the cure of prostate cancer, right? He developed prostate cancer. Rather than throwing $150 million to the American Cancer Society, he built it like a VC fund. And because of him, you and I and all the male listeners will probably die with, but not of, prostate cancer if we live long enough. And then you look at what Bill Gates did for vaccines, I would argue he did more than the US government. So you can't run a philanthropy or a charity exactly like a business, but you can run it more business-like. And how I see this playing out in the family office ecosystem is that more and more you're going to get the Michael Bloombergs, the Michael Dells, the brilliant visionaries in the who've made a tremendous amount of wealth, but they're going to use their skills to solve some of these real world problems. So again, family offices in general, these are more people. They're not corporations. So I think in general, it's the interests are more aligned with what society wants and needs.
Gotcha. And by the way, we are getting questions, and I want to just set a heads up, that all the questions will be addressed when we finish the main part of the interview. So it's coming up soon. So the next question, Ron, is on exits. In different interviews and earlier today, answering the first question, you mentioned the concept of patient capital, which is an amazing concept in my opinion when you describe the family office's investment model. However, aiming at an IPO or a strategic acquisition has its own benefits because in a sense, when a company gets acquired or goes public, it means that market really needs what they're doing. So how would you describe a family office's investment model on the macro level, meaning that the investments are allocated to what really needed for the economy versus what families want to invest in?
Families are going to do what is, look, the market is the market. And I've always believed Milton Friedman, I studied at, at University of Chicago, they taught a lot that in the market is efficient, right? So it will work itself out. And I do truly believe that. I think family offices, touching on patient capital, When I started my career, I worked at a firm called Drexel Burnham. And for people over 45 or 50, I'm sure you'll remember the firm. This was the most profitable firm on Wall Street. This was Goldman Sachs on steroids. This is when Michael Milken created the junk bonds, et cetera. And I'm in the room with, hundreds of people the day Fred Joseph, the CEO, announced that they're going bankrupt. And it was kind of a surreal scene. But what I'm thinking about is, and I asked my dad, again, I was right out of college. Drexel at the time, you could either buy a company, you could buy, sell, or hold. They had on different companies for their investors. And they had buys and holds, but they didn't have any sells. And I said to my dad, I said, I don't understand. There's got to be some companies that are sells. And he kind of smirked and he goes, you'll figure it out. And I did in about 6 months. The problem is, and to answer your question, is that the investment bank, the private, these are all investment banking clients, right? So they make more money on the investment banking side than they do necessarily. So they're not going to take a client who they're making a lot of money on the investment banking. They're not going to put a sell recommendation on somebody that's already a client. So I think that from a macro standpoint, the value that families offer is the model today is private equity and venture capital, buy a company, hold it 3 to 5 years, and then sell it. That's not necessarily the most efficient way to do it. And it's done that way because of how they're compensated. And I'm not making any value judgments. It's just the way it is what it is. The family office, the patient capital, the reason it's such a huge benefit is because they're not tied to an artificial timeline. So let's say you're a bright kid out of Stanford and you got a brilliant idea for a new app. Well, previously they'd go to NEA or Sequoia and they'd try to get funding. And if they did, they think they had it made. The problem with that is that let's assume the company takes 2, 3, 4 years to really, hockey stick straight up. And in the first 3 years, it's doing okay, but not doing great. It's not your decision. It's not the entrepreneur's decision when they're going to sell the company. It's the venture capital firm's decision. And if you're one of 20 portfolio companies, they might sell you, even if they think you're going to hockey stick up because they want to replace it because of how they're compensated. So to me, the model, it all falls back to alignment of interest. The family offices, the smart guy would love to partner with a family office, in my opinion, because perhaps in 3 to 5 years, the company will go public. And the family office would do that if it makes the most sense. But if it makes more sense to hold it and to stay private for 10, 15, 20 years, they will do that. That cannot happen and will not happen in the private equity and venture capital markets. And more alpha is being created on the private side, and companies are deliberately staying private longer and going public much later. So as a result of that, a lot of the profits they were making before are happening on the private side now.
Got you. Another famous concept of yours, which is that alpha is created by operators. You mentioned it a couple of times already during this interview. And family offices are the operators, in your opinion, that are achieving this operational efficiency. Makes perfect sense because people are coming from businesses. Their background is business background. The question now is, how would the corporate governance change in companies owned by family offices or companies that family offices invested in versus traditional model with private equity and venture funds? We know how it works with private equity. You're right. It's just their strategy to hold for 2, 3 years and sell. How is the governance process different with family offices normally?
It's a great question, and it's very different. I had a friend that I know that they just sold a company for literally billions of dollars. And this was a privately held company that was 3 generations. So they were in business for 60 years. And they did things, the way it started out as a mom and pop business, and then it grew to a multi-billion-dollar business. And then they were bought by private equity 6 months ago. So my friend who runs the company, and I know a couple of other executives, they go to the meetings, and the private equity guys, they don't even ask questions about operate. They just want to see the numbers, right? It's not that they don't know what they're doing. They don't care. They just want to see that the trend is progressing well, and that in 3 to 4 to 5 years, they're going to be able to have an exit, which is what the reason they bought the company. So what was interesting is when I was talking to my friend, he was scratching his head because they didn't even ask the questions and they almost didn't care about a lot of how things got operated or how to do things more efficiently. As long as the numbers worked, that's all they cared about. And again, that's a microcosm of what, in my opinion, is wrong with the industry. So I don't think family offices will ever just replace private equity and venture capital because they're necessary markets. But I do believe that they will disrupt private equity and venture capital. I believe they're starting to disrupt them. And I think because of alignment of interest, you're going to see over the next 3 to 5 years, combined with the fact that you've got 65 trillion coming downstream from the baby boomers to the next gen, you're going to see major differences, and more people are going to want to partner with family offices. Now, one of the things family offices have to do, they want to be behind the scenes. They want to be private, right? And that's fine. You're a family, you don't want, but in order to find people and have people know what you do, you have to the family office is going to have to make a concerted effort to explain to the market, we like venture capital, or we like early stage, or we like real estate, to let the people, what I'll call the smart people, know what they're looking to invest in. Right now, that's not really happening. So the mismatch is, how do smart people find the rich people, and how do the rich people find the smart people, especially if the rich people don't want to be known? That's starting to change. And I think over the next 3 to 5 years, it'll become more and more efficient. And I think that we're at a period where, like in the early 80s, mid 80s, when private equity and venture capital disrupted the public markets didn't go away. It'll never go away. But you look at the growth, the exponential growth in private equity and venture capital, it just exploded. That, I think, is what's going to happen. But family offices still have to become more efficient, become less siloed, and become more professionalized, more institutionalized. They have to figure out ways to compensate their people. So if you're a bright kid, comes out of Stanford or Harvard or Yale or wherever, and you want to get in private equity, in general, the today, and this is kind of an example of where, at least in my opinion, the industry is, if a family office pays this kid $400,000 out of school, in general, they're going to look at this person as, this cost me $400,000 as part of the entity. If Blackstone or Carlyle hires this 24-year-old kid and pays him $400,000, they look at this as a prospective, $20 million profit center. So it's nuanced. It's not a cost. It's a prospective profit. It's a prospective profit center. I think more and more families are going to start looking at things like that, figuring out ways how to compensate these people. And as they become more sophisticated, that's when more and more disruption is going to take place. It's not happening today, and it's happening slowly, but it's going to continue to happen. And if you look at it, every major bank, every law firm, every accounting firm, they're all trying to get into the family offices. Why? That's where the money is, and that's where the money is going to be. So it's going to be a fascinating 10 years, but I think it'll be just like the private equity and venture capital industries from the early 80s.
Back in the 80s. Going back to the corporate governance, when a family office invest in certain business, do they still do it through board of directors, or what's the normal practice? Or they go deeper to operational, processes in the business?
Today, there is no normal practice. So you've got some of them, you've got some family offices. A guy could sell a widget company for $1 billion, and he makes his son-in-law, who's a straight A student out of the Kelley School of Business, the CIO. And that's kind of where the industry is. It's going to change. And then you've got some family offices that have really institutionalized this, and they've become really, really efficient. So every family office looks at things differently. And I just think that it's all over the place. I think what's starting to happen is more and more families are starting to reach out to other families to learn best practices. More and more families are working with other families. And I think that's a trend that's going to continue. And the reason that the family office market has exploded over the past, remember, 68% started since 2000, half since the crash. So this is a brand new industry. Half of them started since the crash. A lot of the impetus to start these wasn't so much that they really want to be have a family office and manage money. It's they didn't trust Wall Street. So I used to run a hedge fund, and I had the ability to put up gates. Most people who had a widget company or any kind of operating company, didn't know what gates are. Gates are just simply the ability I could tell you can't sell sell it. So I think part of this, the main reason that there's been so much growth has to do with alignment of interest and trust. And when a family office is going to invest and going to partner with somebody, the first thing, second, and third thing they want to know is, can they trust this person? What kind of human being is this person? The fourth thing is, what's your track record? What's your 1, 3, 5-year track record, your biggest drawdown? That's flipped institutionally. The institutions want to know what's your 1, 3, 5-year track record, what's your biggest drawdown. Then they'll diligence you as a person. So this is much more of a relationship business than it is. And I think that it's a fascinating thing. And I think at the end of the day, it's a better model because it's not based just on numbers. It's more based on relationships.
Ron, we have a bunch of questions, and I know that our attendees are, can't wait to ask their question and get your responses. So I will wrap up a couple of remaining questions on my list into one, because you've already answered a lot, in your previous responses. So number one and the second altogether. Can you talk a little bit about Diamond Wealth, about your contribution into this family office's evolution over time, and how you improve this process, because you work with so many participants in that space? And the second, the next question is kind of a little personal. Can you speak about your experience with Stanford educational system? Because you partner with Stanford, we are in Bay Area. It's all over the place here. The grads from Stanford, from computer science, from business school. So I would love to hear a little bit of insights on your experience working with Stanford.
Yeah. So, well, first I'll answer the first question. What Diamond Wealth, basically, when I ran a hedge fund from 1990 to 2000, and we ran about 250 million. We never had a huge results, but we beat the S&P 10 out of 10 years. So our clients were happy. And then I sold the company. I got into the space. They in the 90s, they didn't call them family offices. They called them rich people. And now they call them family offices. So that's kind of how I got into the space. So what Diamond Wealth does, we're not a business. It's a way for me to deploy a finite amount of capital, but as if it's much larger. So basically what we do, we work with about 100 family offices, and these are families anywhere between $250 million to $30 billion. And we kind of act as a funnel. We invest only in the private markets. I think in the 90s, it was much easier to create alpha in the public markets. I think today, it's much more challenging. I personally just have money in index funds. But in the private markets, which is private equity, venture capital, real estate credit, I think you can create alpha. And so what we do is we'll see deals. I'll see something that looks very attractive. Of the families, if it's an early stage venture deal, there might be 20 families that like to invest in early stage venture. If it's a multifamily real estate deal, there might be 80. If it's a cannabis deal, there might be 7. So I kind of know who likes what. We don't charge anything, but I'm not doing it for self-list purpose. I do it selfishly, because if I put in $1 or $2 million and they put in 40 or $50 million, I'm going to be the first call. And I don't have enough capital to put in $50 million to every single deal. So what I do is I call that first call alpha. And as a result of that, I am able to get some really incredible deal flow. And a lot of the deals that we get in as well come from some of the largest family offices where they've already vetted it. They love the deal. It's just too small for them. Well, it's not too small for me and for my group. So basically what we do, it's a way for me to grow my net worth. And I help the other family offices because I'm vetting the deals. They'll vet the deals too. But I vet the deals, and we figure out a way to, everything's aligned because it benefits them because I vetted the deals. They don't have to come in if they don't want to, but typically the deals that I bring, because of the deals that we see and because I speak all over the country, at different conferences, et cetera, a lot of people will show me deals because they know they can close the deals very, very quickly. And that's the main thing. As far as Stanford's concerned, so we're not doing anything currently with Stanford. Basically, we're looking to create right now a family office center at a different university right now. Stanford is one of the best, if not the best school in the country. And they John Doerr just donated, I think, $1.5 billion for the school sustainability. So they're really focused on that. So we're really not aligned with Stanford now, but we are going to be making an announcement fairly soon with another major university that we will be partnering with. And basically what we're going to do is the issue is that you've got all these families who created a lot of wealth and they made their money. They sold Beanie Babies, or they sold 5 Hour Energy, or Guess Jeans, or Giorgio Perfume, a chain of gas stations, and they have a liquidity event. It's a different skill set to do that than to take $1 billion, grow it to 2, not spoil the kids, do some estate planning, do some wealth transfer, do some philanthropy, and grow the asset base. So you've got a mismatch right now. And I think that, so what I'm trying to create at this other university is an ecosystem where right now, many of the family office conferences, the model is more pay to play. If you're speaking, you've spent 25 grand to speak, and you might be good at what you do, but that's not necessarily the best way to do it. What we'll do is we'll find firms to sponsor it, but it won't be a pay to play. It'll be much more pure. And right now, when the families that I work with say, which conference should I go to, it's hard for me to recommend that. There's some that are better than others, but it's not pure. And I think one of the things that I'm trying to do, my small little contribution to this crazy, growing, inefficient world, is to look at the way family offices can help to disrupt, but figure out ways for the family offices to collaborate more, to work together, be less in silos, and then share best practices. So that's a lot of what I try to do. I'm just playing a small role in it. But it's fascinating because, and I'll end with this, when I got a job at Drexel and I graduated college in '87, my dad was a banker, brilliant guy. And he said he wanted me to meet this one guy who worked at the bank with him. And I'm looking at him like, Dad, I got a job at Drexel. I'm not going to work with a banker. When you're 20 years old, you're a little smarter than your dad. Well, this guy was John Canning, and the industry that my dad wanted me to learn about is something called private equity. And this is the infancy of private equity. 2 years later, Drexel implodes. Madison Dearborn just explodes, and you see what happens. So, look, I think that this is it'll be poetic justice, perhaps, but this is a time I think that as the private equity market disrupted the public markets, that's where family offices are, and that's why I'm so excited to be in this space right now.
Thank you very much, Ron. So I appreciate your insights, and I'm looking forward to your announcement about the university, where that center is going to be. Can we jump over to questions from the audience real quick? So the first question is, how do you get in contact with these family offices? What ROI, return on investment, they're looking for, if any?
How do I get in? Well, I mean, I've been in this business for 25 years, so it's.
I guess they're talking about themselves. I guess they're talking about themselves as investment providers, investment manufacturers of different kinds.
How do they get access to family offices?
Correct. Yeah.
That's that. Again, that's the $64,000 question, and it's challenging because, again, family, it's based on relationships. So I'm sure everybody out there who's listening, whether you're an accountant, a lawyer, private, whatever industry you're in, you'd probably know a couple family offices. And basically what's going to happen is the family offices, they're going to work with you, not based on the fact where you went to school or how smart you are, even though they will have wanted you to go to a good school and be smart, but they want to be able to trust you and know who you are. So I think the easiest way to start is find 1 or 2 family offices that you are close with, that they know who you are as a person, and then leverage that. And then if you do a good job for them, they want to help you and they want to introduce you to other family offices, and then it'll kind of snowball. But basically the answer is find 1 or 2 that in your hometown, or people that you know, that know you, trust you, know what kind of person you are, do good with them, and then they'll introduce you to their families. Because again, family offices want to make introductions to other families for people. So that's how I would do it.
Perfect. The next question we have, what percentage of family offices are minority, African-American owned, and do you see a real opportunity for growth in that segment?
I don't know. is the answer to your first question, and yes is the answer to your second question.
Okay.
There's definitely going to be an opportunity to growth, but I don't know what the statistics are.
Okay. And from the statistics standpoint, it's pretty close segment. There is no much data except for just private forums and events where you can gather on your own.
Yeah, I mean, look, it's not representative of the society. So look at venture capital. You're in Palo Alto. I mean, the number of minority-owned businesses are, very, very small to what it could and or should be. So I think that'll change, but I don't know what the statistics are today. But I do think that things are starting to change, I think, in general. And I think people care, much less about somebody's background than they do who they are as a person.
Right. The next question, I think, is related to the first one. How do businesses, private investment companies that sponsor private investment opportunities, how do they get in touch with family offices? This question specifically is asking about stratification. You started to stratify family offices. Could you loosely stratify and define? I guess like segments within the family offices. How would you define them?
Well, again, with a broad brush from a macro standpoint, family offices are all over the space. So there's different iterations of family offices and different levels of sophistication. I think right now what you're seeing is, like I said, every bank, every law firm, every accounting firm, every high-end service provider, every NetJets kind of company, they all want to get into the family office space. And they're all starting these family office divisions because that's where the money is. I think the answer goes back to the answer for the other question. It's really based on relationships, right? So there's a lot of great law firms. There's a lot of great accounting firms. There's a lot of great, private equity firms. But in order to work with family offices, they're going to have to do the due diligence to understand what really makes families tick. And a lot of that is not just, I want to create as much alpha as possible. Obviously, that's important, but they want to do it in a way that, a lot of family offices won't invest in companies that invest in oil, right? And they want to do things that are impactful. So I think what has to happen is these industries need to understand what makes these family offices tick. And by understanding them, what they need to do is something that most of us are really bad at. It's listening. So when you listen, I was on a podcast the other day, and they asked me the question, like, with this generation right now, the next generation, what's their biggest issue, in my opinion? People don't listen. And a lot of times when you're talking to somebody, you're thinking about how you're going to respond to them before you fully listen to everything they said. So by listening to the family offices and by understanding the nuances in listening, and maybe you'll hear it, it's like they might be telling you, but it might be the very last word or two words they say. You have to listen and understand and empathize. And by doing that, you'll be able to work with family offices. If you just say, yeah, I've got a great track record and I've never had a down year and I've outperformed whatever. Yes, that's important, but that's not a reason why families are going to work with you. They're going to work with you because they trust you.
Got you. We have another question of the similar nature, asking how to get in touch with family offices. And I assume there are a lot of companies that are looking for capital, fundraisers. And that's who we deal with, right? Private companies at the early stage of their fundraising, real estate, infrastructure, oil and gas, and other industries. So is it worth going to family office conferences? Because they're pretty expensive, if you're talking about like early stage companies.
Some of them are, and some of them aren't. And again, it's like anything. The family office conference circuit has become a huge market, right? Because there's so much money involved, so everyone wants to have a family office go to the family office conference. The problem with many of the family office conferences, it's service providers speaking to service providers, and a lot of the family offices don't attend. And if they do attend, they might attend one or two, and then afterwards they don't. There are a few that are really good at this, but I mean, in general,
can you list them? Can you list them? Type of.
Yeah, I mean, Camden's a great firm, Opal's a great firm, Du Bois is a great firm, DC Financial is a great firm. There's really good firms out there that do this, but there's also so many of them. And then it's not that I'm judging that everybody needs to make money in a different way. I just don't think it's the most efficient model.
Got you. Okay. All right, moving on. Couple of very interesting, challenging questions about your comparison of family offices and private equity businesses. The first is, can the family offices be as scalable as large PE firms? Investment scalability, width and breadth of different types of investment strategies, operational scalability, mid-office, back office, technology and reporting scalability. And follow-up question, will they be able to attract talent? You addressed this point about talent, but what about operational efficiency of family offices versus private equity firms?
Yeah, well, the second part of the question, which I addressed earlier, is really important because family offices do have to address, in order to attract talent, if you're going to just try to get talent and get a better price, you're not going to be able to compete with the Carlyles or Blackstones. Period. That's starting to change. There's a woman, Trish Botoff, who's like the top expert in the country in just compensation for non-family office members. How do you incent these people in order to stay so they want to work for a family office rather than Blackstone or Carlyle or things like that? As far as the operations is concerned, look, I think family offices can do this. Can do this. They could scale. They have the ability to scale it. I would argue they have the ability to scale it much larger than the private equity firms, because again, in general, the private equity firms, again, in general, have an artificial timeline. So when a private equity firm buys somebody, the clock starts ticking, and they look at a number called IRR, the internal rate of return. IRR is a moot point for a family office, right? So if you're talking about scaling a company, I think you're going to have a much better opportunity to really scale a company long term with the family office, who, if they're constantly making money and the business is continuing to trend upward, they're going to hold that company. They might hold it for 20 years. So you could scale that a lot quicker than a private equity firm who could leverage a company and scale it, but it need to flip it every 3 to 5 years. So I think the answer to the question is, family offices will be able to scale companies a lot bigger than private equity.
And another question of the same kind, the same nature. I think PE firms, that's the question, focus on operations as well. KKR Capstone Group, Care Burroughs has a COAC group, Apollo has a group of operations who focus on how to operate companies efficiently and create value. So we are not sure how PE firms are not considering an operations, because you focus so much on the operational side, creating alpha, right? In family offices space, that's just a little bit kind of, if you will.
Well, first of all, there are private equity firms, and again, I'm generalizing. There are private equity firms that are great at operating in different industries. All I'm saying is, from a macro standpoint, if you look at the private equity industry in totality, there's more finance people than there are operators, right? That's kind of what I'm trying to allude to. And as a result of that, you're basically seeing more and more decisions are made based on finance rather than, or short-term economics. Short-term meaning it could be 1, 2, 3, 5 years versus what's in the best interest. So there are companies, all of those companies you mentioned, they do have operators. And I'm not saying that private equity firms don't operate. They do. And some of them operate extremely well. All I'm saying is the ones that do it the best typically perform the best. And the funds that do the best are not necessarily the $10 billion funds, because they've got so much capital they have to deploy. We had so many opportunities with families, with situations where families were going to buy a company and they loved it, but then a private equity firm paid like 2.5 times what the family thought it was worth. So that's fine. A family office has the ability to say no and have patient capital and not do anything. The private equity firm typically doesn't have the ability to constantly say no, because they've overpaid for many firms in the markets, and you kind of scratch your head, they have so much money in the market. So I think the part of the problem is that one option is, if the market is ridiculously overvalued, which it was pre-COVID, the private and people thought that the market's overvalued, the private equity firms could return capital. I think you're going to get a grand total of 0 that are going to do that. The family offices are just going to stay patient and sit on their hands. And the private equity firms are just going to bid and pay ridiculous multiples. And, they have to deploy that money. So I think that from a macro standpoint, it's not as efficient of a model. And again, I'm generalizing. This is not true for every private equity firm, et cetera. But from a macro standpoint, you are seeing companies that you're seeing ridiculous multiples being paid by companies for private equity, that a family will love the company, but a private equity firm is going to come in and pay 2-3 times what they're going to pay, and they'll just say, "Fine, take it."
Gotcha. Yeah, and I think we covered most of the questions. Just a quick follow-up. There have been a lot of studies in Silicon Valley on venture capital investment that showed that only top like 10, 15 companies in the whole space are returning those multiples. The rest of the market is just losing money, right? And that it was an analysis for over a decade. Smaller VC firms that came in like there are plenty of those that came over past like years before the recession in Silicon Valley. They were trying to follow the large firms and basically kind of invest in the same deals, which is normally very hard. But the statistics are showing that only top 15, 20 firms are performing. The rest is not. The rest is not. So is it something that you would also, is it phenomenon relevant for the family offices world as well, or not?
Well, family offices do invest in venture capital. And I think part of it is, remember that with 65 trillion coming downstream, a lot of the next gen, the people in their 20s, 30s, and 40s are going to be pulling the trigger, not necessarily just the people in the 50s, 60s, and 70s. And they're more in tune with a lot of the new technology and a lot of the venture. So I think that in general, family offices, they definitely do invest in venture. And I think that as the family office market evolves and becomes more efficient, more and more money will go into venture. I think that venture, as an asset class in general, it hasn't performed as well as private equity. It hasn't performed as well as real estate. But if you find ones that are on the top decile, the top 10%, you could do extraordinarily well. So I think diligencing which specific funds to go into will be more and more critical.
All right. Ron, thank you so much. We've covered a lot. I really appreciate your time and insights. It was an amazing interview. Thank you so much. We answered all the questions that were submitted, but if anyone from the attendees list have any more questions, by the way, they can follow up. We can accept some questions over email and we can communicate further with Ronald. So on that note, once again, truly appreciate your participation and time. Thank you so much for this amazing interview, and I'm wishing you all the success and great day.
Thank you for your time. It's been terrific. I appreciate it.
Thank you very much, Ron. Bye-bye.